Let's talk about property taxes and why they go up after buying new construction. And this isn't true all the time, but it's most of the time. So here's why. Before we get into it, let's talk about a few disclaimers. I'm in Texas, so we're going to talk about how it works here in Texas, but fundamentally, it's the same across all states. The difference is some states require multiple tax payments throughout the year. Texas only requires one, and that's at the end of the year. So Texas, the taxes come due in October. They're not late until after January 31st. So when they post early to mid October, the homeowner then has 3.5 months, give or take, right? They got the rest of October, November, December, all of January to pay the taxes. So you pay whenever you want, as long as once they post, there you go. It's time to pay the bill. So if you have an escrow account or if you don't, this still applies. And I'll talk about if you do have an escrow account, why this gets a little tricky and little funky, and I'll put that at the end. So in Texas, you get a notice of value, a tax valuation that says, call it March time period ish. You're going to get something in the mail that says, hey, this year we think your valuation is going to be this number, right? So with new construction, this is what makes it tough. Is new construction, they're going to say, hey, there's foundation and there's framing. So now at this moment in time, in March, February, March, whenever they do this evaluation, they're going to say it's $100,000, valuation. And maybe it's going to be a $500,000 home. But for right now, they're saying, hey, it's 100 grand. Well, the cool part is for that year, your taxes are only based off that 100 grand because that's what it was at that moment in time. And so this year, and let's make up numbers on that 100 grand in Texas, that could be $2,400 or $200 a month, right? When you phrase that out to say, hey, it's $200 a month this year for property taxes, and that's the whole year, even if the house gets done in September and you move in and everything's great. But the reality is the whole year is based off that low number. And that's why the following year, the following March, when you moved in and the house is a home and you're sitting in there and it's a $500,000 home, well, that February, March time period, the following year, they're going to say, hey, your taxes are now based off 500 grand. So instead of having a $2,400 bill at the end of the year, this year, now that it's a $500,000 valuation because the house is done and ready, you're going to have, let's use a number of $12,000 due at the end of the year. So it's $1,000 a month, quite the jump. And that's fine because that's normal, right? That's what it's supposed to be. And that's, again, there's homestead exemptions. So check all that out and you can, lower that number. But my 12 grand is just for round number for this purposes. But understand that 2 grand first year feels really good. Next year it's going to be 12. So if you waived escrows, meaning you pay your own taxes every year, cool. Just be expecting the check to be a lot bigger the following year after you moved into the home. And by the way, side note, another example could be, maybe it's not that drastic, which could be maybe in February or March, the house is, it's not just framed, it's bricked, the roof is on, maybe even there's flooring in the house. They're just not done, and somebody may close, like let's say in May or June, and so maybe they get the valuation 400,000 at that time versus the full 5. And so again, the tax bill is bigger. It's just not the full amount. So whatever it may be, that's why the taxes the following year typically are going to be more for new construction, unless the house was already done at the time of the evaluation. So that's why property taxes go up. So here's the catch with escrows. If somebody has taxes as part of an escrow, meaning it's part of their monthly mortgage payment to a mortgage servicer, if you have that piece, here's what's going to happen. When you set up a good lender, us, right, the mortgage market team, would highly recommend that we set up the taxes on the what's called improved valuation. So the 500 grand, not the unimproved, or in this example, the $100,000. That's the unimproved land. The house isn't done. So we're going to recommend, look, let's just suck it up and let's just do this to where we set it up as if it's the $500,000 valuation. So if we do the $500,000 valuation, then that year when you move in the house, whatever month that's going to be, you're making the full payments. Let's say you buy it in September. That means when your payments come due. So if you close in September, your first payment is going to be due in November. So for November and December, you're paying in the $1,000 a month for property taxes, even though that year's bill is only $200. What then happens is the following year, the following February, March, when there's an escrow evaluation, an escrow rebalancing, the escrow company is going to be like, oh, we got way too much money, and they refund the difference to you, the homeowner. So we'll put a link in there about the escrow rebalancing and how that works. But that's what we recommend doing, is setting it up on the improved, meaning what it will be, versus the unimproved. Because then if you set it up on the unimproved, what happens is you're sitting there feeling really good. You're paying $200 a month, and the escrow analysis that takes place following year, they may not say anything. They may let you go on this next year paying the same $200 because there was no shortage, because the $200 in this example was accurate. So next year, when they look at it in February and say, oh no, everything was cool, we don't have any extra money, good, we're good. Well, if they don't think about it, or if you don't initiate it and they don't do anything about it, you're going to go all next year paying $200 a month. And at the end of the year, when the bill's 12 grand and not 2,400, you're going to have a problem. They're going to then send you a nasty gram and say, yo, you owe us like 10 grand or something close to it, right? So that's the reason why when you set up an escrow account, we highly recommend, right? Highly recommend setting up off the improved property. And again, we do a lot of new construction, the Mortgage Mark team. So we absolutely know what we're doing. We absolutely recommend it. You should do it too. That's my recommendation. And hopefully that helps at least understand why the property taxes go up. It's because, again, the valuation in February is what the taxes are based off of, not whenever the house is finished, at least for that first year. So if you have any questions, please reach out to us. The team is here to help. And as always, we thank you for watching. And when you think mortgage, think Mark.